Hey guys, welcome back to a brand new video. I'm RexFinance and happy football weekend. Go Chiefs. Woo. Anyways, today we're going to be exposing the Fed's evil plan. Okay, yeah, that was pretty dramatic. I apologize. But the Fed's evil plan needs to be discussed. Believe it or not, this Sunday, the Super Bowl is not the only big day coming up. We also have next Tuesday, which is perhaps even a bigger day. And that's because next Tuesday, we get our next inflation data. Who's with me, these stock market nerds loving these inflation readings? I know. But at 8:30 a.m. Eastern Time, we will be getting our updated inflation data for the month of January. Obviously, the expectations are that inflation is going to keep falling and falling and falling, at which point, sometime in 2024, we're going to get back down to the 2% inflation target that the Fed is, well, targeting. But unfortunately, the Fed's evil plan really probably is not going to care what inflation does over the next 6 to 7 months. And that's why it's an evil plan. At the end of this video, I will be talking about some small caps. Okay, not gonna lie, I just took that off of a toy Woody, Buzz Lightyear. Oh, sorry, bud, your head's crazy. I need you to subscribe, and I need you to hit the like button. Now let's get into this. So to set the stage here, yesterday on Thursday, we got new data that initial jobless claims rose to 196,000 during this previous week, and continuing jobless claims rose to 1.69 million, up from 1.65 million. The jobless claims number was actually higher than the expectation of 190,000, so yes, we're finally starting to see some jobless claims roll in. This labor market has been insane, propping up the economy, and that is exactly why the Fed has an evil plan. But what most people don't understand is at this point in time, the risk to us investors and the stock market right now is not whether or not the Fed can pull off a soft or soft-ish landing. It looks very likely that the Fed is going to be able to do that. The risk here is that Jerome Powell is going to go too high for too long, and after sticking the soft or soft-ish landing, we're just going to fall into a recession in 2024, a few months after sticking that soft landing. So the soft landing would be pointless. This strong labor market is great to see. I'm glad you guys have jobs. I'm glad you're getting new jobs. I'm glad you're not getting fired. But to the Fed, this job data is not very welcome. And that's because when we have jobs, we have purchasing power in our pockets. We still go out there and spend our money, which props up prices and holds prices consistent and really doesn't allow them to fall much. So the strong labor market we're experiencing is keeping the door open for a soft landing, but it's also prolonging this fight against inflation, and it's exactly why Powell wants to keep rates higher for longer. Because just in a matter of days, inflation could tick right back up and we could be experiencing doomsday overnight with resurging inflation because consumers still have jobs and are still spending money. Every inflationary cycle is different. It's caused by different things. The economy is in different positions, and this is no exception. This most recent inflationary cycle is coming on the heels of the pandemic, when lots and lots of money was being injected into both businesses and consumers' pockets. Meaning, during this inflationary period, yes, it sucks. We're spending more at the grocery store, at the gas pump, but we also can afford it because we stockpiled a bunch of cash and had all this cash infused into our pockets just 2 or 3 years ago. That is why the economy is staying strong. That is why blue-collar workers are not getting fired. If you've been following my channel, you know that I do think an economic slowdown is likely. I don't think we're going to go into a full-bore recession where we all are feeling huge pain, losing all of our jobs, etc. I think a slowdown is likely, so do not get me wrong in this video. I think a slowdown is likely. You can't raise rates by this much without experiencing some sort of pain. However, there is a reason that the layoffs and the pay cuts and the executive compensation cuts have happened in basically one sector and one sector alone. And that obviously is the tech sector. And this is another really good reminder that this time is very different from any other time, because half of our economy, the tech companies, experienced their best growth opportunities in history throughout the pandemic, while the other half of the economy experienced their worst opportunities for growth and were literally shut down during the pandemic. So we have these tech companies that grew tremendously fast, and all these other businesses that had to lay off employees, had to close up business for good, etc. There's a dichotomy there, two different sides of the economy. So the one side, the tech sector in particular, experienced tremendous growth, meaning they had to hire a bunch of new employees to take on new projects and to grow their businesses and to build their software better and all that good stuff. The other side of the economy was the complete opposite. Fire workers, cut pay, close up shop, close business for good. This is exactly why you're seeing layoffs happen in the tech sector and basically nowhere else. The tech sector has a bunch of fat left over from the pandemic that they need to cut off of their business. If you've noticed in the news lately, there's been a lot of tech workers losing their jobs, getting fired, taking pay cuts, etc. And whenever that news comes out, say it's Facebook that announces 10,000 workers are going to be laid off, their stock price moons. It goes way up. You know why? That's because Wall Street knows that these companies can operate much more efficiently and deliver more profits and a higher profit margin after laying off the workers. That is the fat we're talking about here. One really good example of this is Apple's CEO, Mr. Tim Cook, who is going to receive a big pay cut in 2023. Overnight, the company and its shareholders decided that Mr. Cook's 2023 target total compensation will be $49 million, darn, which is a reduction of 40% from his 2022 target total compensation. 40% pay cut for the CEO of one of the largest tech companies in the world. And you know what? Mr. Tim Cook is not going to feel the difference. An example of fat on these tech companies that is getting cut off. Or if we look at David Solomon, who's the CEO of Goldman Sachs, overnight they decided his 2022 compensation would be cut by about 30% to $25 million. Darn. My only concern is I don't know if these guys are going to be able to afford eggs. Okay. All right, I'm going to go put this back because this is like holding a gold bar in my hands. I cannot drop this. Be right back. Now, if you want further evidence that the economy is in better shape than is being represented in the media, American Express, one of the largest credit card companies in the world, if anybody knows consumers, it's these guys. Their CEO, Steve Squeri, isn't seeing signs of a recession from its customers. This was just a couple weeks ago when he came out and said that. We also need to remember that if blue-collar workers do start to lose their jobs, and they will, it is inevitable. I just don't think it's going to be quite as widespread as people think. Companies have the leeway right now to cut their prices and boost their retail sales numbers. They have that incentive to boost their sales and hence drop the prices, which means consumers are still going to be spending money and buying products. This is especially true in the goods sector, which is where we've seen the bulk of our deflation or disinflation, if you don't like the deflation word. But believe it or not, deflation is here. So this all ties into the Fed's evil plan. Our economy is holding up way better than anybody expected. And it needs to be known, not every time that the Fed has to raise interest rates do they have to drive the economy into a brick wall. I firmly believe that this is one of those exceptions where we can avoid running into that brick wall, bring inflation down while the economy stays strong. But again, this is where the risk comes. If the Fed keeps interest rates higher for longer like they say they're going to do, which will happen, that is what they are going to do if the labor market and economy remain strong, we risk recession and economic hardship in 2024. Now, the opposite can also be said. The Fed is just not going to say the word cut. I mean, if you watch Jerome Powell's most recent press conference, he said everything but the word cut. He said, oh, we'll use our tools to react to a depressed economy, yada, yada. He didn't want to say the word cut because you know what the stock market would do? The first time Jerome Powell says the word cut, gap up. But if the economy does start to experience hardship, people do start to lose their jobs, and that balance comes back into balance or out of balance on the other side, the Fed is going to cut rates. I just simply don't see that happening right now. Now, if you do want to see something a little bit scary, just look at the federal government current expenditures interest payments chart. That was a mouthful. But this first quarter of 2023, because the Fed has raised rates so much and because federal government debt keeps going up, this first quarter, they're going to pay over $1 trillion in interest payments. And unfortunately, that's just going to get worse. I mean, there's going to come a day where we have to reconcile for this, where we're going to pay the price for the ever-increasing debt in the country. And this is kind of the start of it, because you know how they make these interest payments? They print more money to pay the interest payments, which, we all know causes inflation now. All right, so lastly, let's talk about our small caps. I'm going to do my best to keep this small cap on my head, try not to distract you. Lots of people are mistaken that they think the stock market has just been, unbeatable the last 5 years or so. But there are some sectors in the stock market that tell a different story. Okay, I can't balance that on my head. I'm sorry. For example, the small caps. Russell 2000 over the last 5 years is only up 24.63%. Typically, every 10 years or so, you want to be doubling your money in the stock market, or that's the common benchmark. This is lagging significantly. If we want to hit that benchmark, the next 5 years are going to have to be really, really good for small caps. This is why I have positioned my personal portfolio to favor more of the smaller companies out there. Yes, they were the first to feel pain when the stock market first went down in 2021 and 2022. The small caps felt the biggest pain, and it took several months, and then mid caps started to fall, and then another several months and large caps started to fall. This is why if we see small cap stocks start to rally, it's pretty certain that the stock market has at least bottomed locally in the short term, because small caps are the first to fall, but usually they're also the first to rise. So this is a really, really good sign to see. Small caps are up 10% year to date. That is really, really good. And then to wrap this video all together, I want to look at valuations in the stock market. Right now with small caps, what we've been talking about, the small caps, small cap valuations are historically below average, and this is going back to 1999. They are way below average. Average is about 17 or 18. Right now, we're at 13.7. Mid caps tell a similar story. Mid cap valuations are very low historically. Large caps, I would say, are in line with their valuations historically, and it's going to be really interesting to see what happens to these valuations as more and more large companies report their earnings. But again, this is why I've positioned my portfolio into small and mid-cap companies primarily, because they are set to see the best next 5 to 10 years just based on the data we have. We also have the fact that eventually the Fed is going to cut rates. Eventually, the economy is going to return to robust growth. That's another common misconception right now. Most people think the economy is contracting. It is not. Last quarter, the GDP was like 2.4 or 3%, something like that. The economy is still expanding. So in conclusion, the Fed's evil plan is very evil. They're going to keep rates higher for longer just based on what's going on in the economy. They cannot afford to cut rates right now or anytime soon. This plan and strategy makes a lot of sense, but it also gives us the risk of maybe seeing a recession in 2024 if the Fed fails to recognize the economy starting to struggle or fall over, which we all know the Fed is not the greatest at seeing what the economy is doing or what it will do over the short term, so cross your fingers.